Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
And if you look at a chart of gamma, it actually shows you over a 15-day period and a 45-day period what the gamma would be. Obviously, the more I said the near-term at-the-money option, which in this instance is the 15-day 85 strike call, usually trades at a higher gamma. Now notice on my graph, on the x-axis we have the stock price, and on the y-axis we have gamma. And gamma is only going between 0 and 10. And that will normally be the case. Gamma is not going to be a big number relative like a delta in general, because it's the rate of change of delta. And just like how delta is normally smaller than the stock, as far as the rate of change in the stock, gamma is usually smaller than delta, because you're talking about the rate of change of the derivative that's on the stock. All right? So where's the most explosive one? A 10-cent gamma right here. If we look at that, 15 days remaining, we have a very explosive option contract on the red line right in the middle. As we go further out in time, we see gamma get smaller. As a matter of fact, when you go from a 15-day option to a 45-day option contract, we see the gamma get cut in half. Now, a lot of people might say, well, gee, the gamma is only 5 cents as opposed to 10 cents. Who really cares? It's only 5 cents on this. But when you think about this in the options world and you think of buying one option contract and your delta increases by 10 as opposed to by 5, that delta really translates into shares of stock. Since delta represents how much your option will move for a 1-point movement in the stock, and each option represents 100 shares, if gamma says it will move by 10, you're actually talking about 10 shares of stock on the delta side, as opposed to your option contract moving by, or the delta moving by 5, which gamma would be on the 45 strike call. And in that instance, then you're talking about adding basically 5 shares of stock. That's how much difference your stock and your rates of return would be between these two option contracts if you're correct on your forecast and it becomes a positive number. Now, I always got to talk about the downside too. Now, remember, obviously, when it goes down, it's going to be working against you in the same fashion as I described on the upside. All right. So, gamma is good if we are a good stock picker. If we are good at picking underlyings, we like to have high gamma option contracts, because that means that we're going to get more leverage and we're going to get an option that's going, once it gets in the money, is going to approach one much faster than any other option contract out there, as long as it's got high gamma. All right, so keep that thought in mind, because now I want to introduce one other Greek, and I want to talk about the relationship between gamma and this Greek, and it's a very important relationship to understand. All right, the next Greek is actually theta. Theta is the amount an option's theoretical price will change for a corresponding 1 unit, or in this instance and in most instances that unit is a day, change in the day's expiration. Now, theta is a larger number on longer-term contracts, and a lot of people don't realize that, but they always think of, oh, theta is large on the near-term option contracts, but theta can only mess with the time value of the option. So if you go out further and further in time, there's going to be more time value. So theta will be a larger number, but it may be a larger percentage of price if I look at a near-term option contract. So if I have a near-term at-the-money option, theta will definitely be smaller than a longer-term option. But as far as what it represents in price, 10 cents on a $1 option is a big deal as opposed to 20 cents on a $5 option, if you get what I mean. So nearer-term options usually don't trade for as much, but theta can be a big percentage of that price as compared to a longer-term option contract. All right. I actually have a way to look at time decay, and when you talk about time decay of an option contract, we'll talk a lot more about theta as we go out further in time. But if you look at a 1-month option contract, and we're just going to talk about an at-the-money call because this is all time premium. And when you look at options, the at-the-money option contract has the most time premium relative to in the money and out of the money in the same expiration. Why is that? It's where the most speculation is. You get the most bang for your buck, you get the most gamma, but you also are going to have a very high theta. So you pay that price. So when you think about it, as an option gets deeper and deeper in the money, what happens to time premium? It starts shrinking and gets smaller and smaller. So theta becomes smaller and smaller. As you go further and further out of the money, obviously the speculation, the odds of it getting there are much lower. The price of the option is going to reflect that. It will get much smaller, which means you're also going to have a smaller theta on a more out-of-the-money option contract. Excuse me. All right. So if I have a 1-month option contract, though, let's just kind of look at how the relation of time decay works. If I have a 1-month option contract, 30 days worth of time, trading for $1, and the world was logical, though, you'd think that a 2-month option contract would trade for 1 times 2. I paid for 30 days, it was $1. 60 days should be $2, and 90 days should be $3. But if you traded options, you kind of know this not to be the case. And I hope everybody's sitting down. Are you ready for this? When we looked at the Black-Scholes pricing model, you could have noticed this, but it's not. I don't expect you to ultimately. But options actually decay or move at the square root of time. And in a utopian world, you could actually figure out these at-the-money options with no intrinsic value very easily if you started off with just a 1-month option. You only dealt with simple time periods, 30, 60, 90 days. Options move at the square root of time, which means if you want to look at a 1-month option trading for $1, a 2-month option would be trading for $1.41, and a 3-month option contract would be trading for $1.73. So in this instance, I can see that when a 3-month option contract becomes a 2-month option contract, I'm going to lose about 30 some odd cents. And then when a 2-month option contract becomes a 1-month option contract, I'm going to lose 41 cents. And then when a 1-month option contract, stock still doesn't move and it becomes a 0-day option contract, we're going to lose that entire $1. So if you were to graph this, you actually see that options not only decay, but they decay at an accelerated rate as expiration approaches. So right in here, this is about the last 10 days, you see an enormous rate of decay on your option contract, and that's where some of the biggest part of option trading or of time decay happens. All right, so in order to describe this and to talk about this, go back and look at time decay. And let's think about a strategy now, and let's talk about a strategy. This strategy actually I think is a decent strategy in this day and age for the currency options that are trading on the ISE. Reason why is that implied volatilities have came off immensely, but I still think we're going into October, November, December. We're getting very volatile times overall for the marketplace. In general, it has been. It has proven to be over many years of trading in the markets. So if I'm looking at options and I want to participate in a movement, but I don't know how much the underlying is going to move. Oh, I actually got a question here from Alex. Let me address it. He says, so it's better off to just sell the option, right? And the answer is no, Alex. I mean, there's always trade-offs. And this is why I want to address this, and this is why I'm bringing up this question. And I'm going to do it by talking about a long straddle.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.